Hello everyone, this is Alok. Friends, how are you doing? Hope you all are well. So in this video, I'm going to give you a very good brief concept on mutual fund and benefit calculation. What is, what is the mutual fund? Second, how it functions. Third point is history of mutual fund in India. When mutual fund was started in India. Fourth point is why should we invest in mutual fund? Fifth one is limitations of mutual fund. Sixth one is fund type, and seventh one is risk versus return, and the eighth one is type of mutual fund. And again, next is investment and strategy of mutual fund. 10th is conclusion, and the last one is very important, that is on mutual fund benefit and calculations. Okay, let's move to next slide. So first we have to understand concept of mutual fund, right? What is mutual fund? A mutual fund is a professionally managed form of collective investment that take the money from many clients, many investors, and further they invest in stocks, bond, real estates, and various other entity, etc., etc. And also, mutual fund has a fund manager who invests the money on behalf of investor by buying, selling stocks and bonds. And also, mutual fund is a trust. Now the question is coming: why we should trust for investing the money through mutual fund? As because a mutual fund is a trust registered with the Security and Exchange Board of India. We call it SEBI. That is the government agency, right? So let us understand what is AMC actually. So AMC is a asset management company, and it consists of group of experts who knows how to manage the money to pull from you through invest in stocks, bond, and real estates, etc., etc. Now, what is fund manager? Who is fund manager? What is the role of fund manager? So, in the AMC company, the expert work continuously, taking the money from you and come up with a certain scheme to get the best return for you. AMC has a lot of scheme, and each scheme has a fund manager who is prime responsible to manage the fund. So let us move to next, and here we will understand how mutual fund is works, how mutual fund works, how much, how what is the rotation of mutual fund, what is the rotation of money, and how we get the return. So first of all, mutual fund company, they take the money from us, money from various investors, and then they invest in mutual fund, and then again through mutual fund they invest in different entity like bonds, security, real estate, etc., etc. And when and it generates the return. After investment, it generates the return. When returns are generated, it goes back to the investors like you. So this is the rotation, how it function, this mutual fund. It is a cycle like. Now let's forward, move. Now little bit we have to understand the history of mutual fund in India. So this is the brief information about the mutual fund in India. A mutual fund is business was started by UTI, Unit Trust of India, and the first scheme introduced in 1964, popularly known as Unit 64. UTI was only the player in this business for 2 decades. Yani nearly 20 years only UTI was the player in this business, right? Thereafter 1987, after 20 years, 1987, SBI was allowed to set up a mutual fund in the same business. Now earlier mutual fund were now how mutual fund was managed earlier. So earlier mutual fund were governed by Ministry of Finance and RBI. So it is under control of government and RBI. Later on time, 1993, SEBI issued guideline on mutual fund. Right? Let us move to next. Why we should invest in mutual fund? This is the great question. Okay, fine. Definitely why we should invest in mutual fund? As because of three reasons. One is experts are on your side. Second is when you investing the money through mutual fund company, there will be a limited risk. Third is affordable investment option. So this mutual fund company is investing the money through collective after collecting the money from various people, after the various investor, and then them investing the money in mutual fund. So it is you bear lesser investment cost, whereas if you alone doing it means the investment cost will be much higher than the being invested by mutual fund company. So first one I need to explain actually. Expert on your side. Expert on your side means when you invest in mutual fund, you buy into experience and skill of a fund manager. You are using the because you don't have experience. So the one who is in this business day night they are working for the same business and doing well. That is why they are highly skilled, highly professional, and they managing the fund is in a very nice way. The third one is limited risk. Second one is limited risk. Mutual fund are diversification in action. They don't invest in one entity only. They keep the portfolio diversified. Let us move to the next. What are the limitations of mutual fund? So limitations we should know. Mutual fund are subject to the market risk. Yes, of course. No guarantee of returns. This is also true as they are investing in equity and other things. Third one is diversification of portfolio, maximize the returns. This is minimize the losses. Now fourth one is selecting right financial security is not easy since they are highly professional, highly skilled. They are working on day night, working on the same business. So for them it is very easy to select the right financial security, right? The last one is the investor pay investment management fee as long as he remains with the fund even while the value of investment is declined. This is the drawback actually, but it happens very sometime. Now let us move to the next. Now we have to understand the fund type. So there are six types of funds. One is liquid fund, second is debt fund, third is balanced mutual fund, index fund, next is equity fund, and last one is sectorial fund. So the most common fund are balanced fund, equity fund, and debt fund. So usually people are investing in this type of fund. So let us understand what is liquid fund. These mutual funds invest is in bonds and money market instrument with maturity no longer than 91 days. Please note, no longer than 91 days. Liquid funds give the regular and fixed income. Right. Now next is debt fund. Debt fund is also same as the liquid fund, but this is we can it is invest in longer time more than the 91 days. So a type of mutual fund that generates steady income in the form of dividend invest in the bonds, right? In the both the cases, investment is done for the in the bonds only, and all liquid funds are debt fund, but all debt funds are not liquid fund. Please note, all liquid funds are debt fund, but all debt funds are not liquid fund, right? So the third one is balanced mutual fund. Balanced mutual fund is a nothing but a hybrid fund. This is the mixed fund. In this fund, stocks and bonds such as 70% investment is done in the stocks and 30% done investment is done in the bonds. So next is the index fund. These mutual funds creates a portfolio which mimics given index. Normally, when the index is perform well, your money growth will be there, and when it growth performance will come down, you will your wealth will deteriorated, declined. So this is directly proportional to the wealth is directly proportional to index fund. Index fund it goes high, your wealth will created. Index fund will go low, wealth will be deteriorated, declined. So next is equity fund. An equity fund is a mutual fund scheme that invests more than 60% of the scheme's asset in equity stocks, right? So it is quite risky compared to the other above four: liquid fund, debt fund, balanced mutual fund, and index fund. Now the last one is sectorial fund. It is an equity fund that invests the money of investor in business belonging to the same industry or sector. This is very risky actually. So investment in one sector or one company, it is highly risky. But where is the risk? There is a gain. So sometime in the market there is a rotations always. Sometime one sector going up, like oil and gas is going up, performing well. Sometime IT sector is performing well. Sometime pharma sector is performing well. Sometime chemical sector is performing well. So if doesn't perform the sector in the sector you invested and doesn't perform, then wealth will not be created. Rather than creating, it will deteriorate it. I mean, decline. So it is quite risky. Risky. Now let us understand the risk versus return. As you know, where is a return, there is a risk always. If risk is low, return is low, right? So already I have explained about all the type mutual fund type, right? First is sectorial funds. I told you this is the highly risky, but returns are also more. Come to the next, equity. This is the less risky than the sectorial fund, but even though it is risky. Then come to the index fund. It is less risk, less risky, less return. And after that coming balanced funds. This is the most common funds actually. So also this, then it comes debit fund, then liquid fund. Now the most least risky, but return is also very small, right? So move to the next slide. Here we will understand type of mutual fund by structure, by investment objective, by other scheme, right? So first understand by structure. So by structure, it is two types: open-ended, or in open-ended, anytime you can entry and exit. Second one is closed and ended scheme. Closed-ended scheme means redemption. You cannot withdraw the money unless and until the period of scheme is not over, right? Now come to by structure objective. Equity growth. Only in stocks. It can be invested only in stocks and for long term, 3 years or more. Second is debit income. Only in fixed income security. It has invested in for 3 to 10 months like. Third one is liquid money market, including gilt. This has been invested for short term money market. Normally it is invested in government scheme, right? The last one is balanced hybrid, stocks plus fixed income security, right? So normally it is invested for 1 to 3 years. Now other schemes are tax saving schemes, index scheme, sector specific scheme. Okay, let us move to the next. Now investment as strategy. You come to the investment as strategy of mutual fund. Normally people are, this is the most popular investment strategy, systematic investment plan. We call it SIP. Now in SIP, invest a fixed income sum every month, 6 to 10 months, through direct debit facility, right? It is clear now. Now next, less unit. When the share prices are high, we should take less unit, and more unit when the share prices goes lower side. So average cost price tends to fall below the average NAV. The second is systematic transfer plan. We call it STP. Invest in debit oriented fund and give instruction to transfer a fixed sum at a fixed interval to an equity scheme of the same mutual fund. We are getting through STP, we are getting some fixed income every month. So it is good. The third one is systematic withdrawal plan, SWP, to withdraw a fixed amount each month, right? So moving to the next slide on conclusion. Now the conclusion is like mutual fund offer investment the opportunity to earn income through professional management, right? Second one is risk is diversified by portfolio diversification, correct? Now the third one is mutual fund are not liable to pay tax on the income they earn. This detail we will talk in some other video for this point, right? Convenient option for the investors. There will be, you will get various options for investment here. And the last one is uh, regulatory comfort in mutual fund, and because SEBI has mandate strict when the government agency come into the picture and these things control under SEBI. So it has mandate restrict check and balance in the structure of mutual fund and their activities. It is being regularly being monitored by SEBI for all mutual fund agency and all. Now come to the next. This is the most important. Here I have calculated based on the 1 crore I have calculated here. Now see, first year when you investing 1 crore rupees. Now let us understand interest 12%. See, normally what happen in any mutual fund, minimum we are getting, minimum in worst case we are getting 10%, maximum 30%, 40%, 50% like we are getting. But average is what we are getting. This calculation has been done 12% interest on investment, right? So next is 12%. At the rate of 12%, how much it will become? 12 lakhs. Total amount with interest, how much it will become? 1 crore 12 lakhs. Now for expenses purpose, suppose for expenses I am withdrawing per year 8 lakhs, right? Then what would be the balance amount? 1 crore 4 lakhs, right, in hand. After withdrawing this 60 monthly expenses, we are withdrawing 66,700, like, right? Now come to this next year. Next year, how much it is investment? See, here it is the power of compounding. You will see the power of compounding, right? So how much with at the rate of 12%? Every year we are getting minimum 12% average, except if any year will come some big pandemic or uh, some big war, like in that case only maybe we will not get. Otherwise 12% minimum we are getting this in mutual fund average. So amount with interest 1 crore 16 lakhs 48,000, withdrawal amount 8 lakhs 40,000. So next year we have to withdraw 8 lakhs 40,000. So additional 40,000 why we are withdrawing? As because of inflation. We are considering here the 5% inflation. So 5%, after 5%, considering the 5% inflation, how much it will become? 8 lakhs 40,000. Now the balance amount is 1 crore 8 lakhs 8,000. How much monthly expenses we are be doing? 70,000. Now come to the 10th year. After 10 years, what will happen? After 10 years, your investment cost will be 1 crore 37 lakhs after withdrawing this much money every month. And the balance amount, it is how much? 1 crore 41 lakhs. After withdrawing this much money, right? After withdrawing this much money per year and every month, how much we are withdrawing this month. So this is the magic of investment in mutual fund. So friends, how was this video? Please do subscribe, like, give comments if this video is really informative for you and you are learning something, so that I can keep continue for making such type of informative video for you. Okay, thank you.